Welcome to CAS Research. Before we begin, I'd just like to make a note that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
In today's session, we are going to be talking about candlestick patterns. They are a form of technical analysis and charting used in the forex markets, stock markets, and all other markets. They can be used in all time frames for those looking for longer to shorter term trading or investments. The power of the candlesticks, also called Japanese candlestick charts, is that they surpass at given market turning points and when used properly can potentially decrease market risk exposure. You may have seen or heard of some common candlestick chart patterns or candlestick terms like bullish engulfing pattern, doji patterns, hammer pattern and shooting star patterns. So let's take a look. Since the 17th century, the Japanese have been using a unique style of technical analysis to analyze rice prices. This technique is candlestick charting. The Japanese candlesticks are a way of displaying the price action over a set period of time. Candlesticks contain the same data as the normal bar chart, but emphasize the relationship between the opening and closing prices. The art of candlestick reveal market sentiment or possible reversals in the markets by showing the price movement in a specific way. The candlestick. Here is a graph of a bull candlestick and a bear candlestick. So the bull candlestick is white, or depending on how you set up your chart, you can have any colors specifically how you like. You could even have a black to a red, indicating that the black being the bull side and red being the bear side, but for this instance it's white. So when the close for the day is higher than the open is bullish, and when the black candle closes lower than the open is a bearish candle. The wick tails sticking out of either end of the candlestick represents the range between the day's high and low prices. And as you can see here, the wick on the top side shows the high and the wick to the bottom side is the low. Candlesticks are easy to understand. From a beginner to the experienced professional trader can easily bind the power of the candlestick charts. Candlesticks can provide early signals, turning points. So candlestick charts characteristics can signal early reversal signals, whereas a bar chart may easily take days or weeks to indicate a reversal signal. This would assess the trader to take action in advance and help enter and exit the market with better timing. Candlesticks provide unique market insights. Candlestick charts not only shows the trend of the move, as does a bar chart, but unlike bar charts, candlesticks also show the force underpinning the move. Here is a doji candlestick. The doji candlestick is one of the most revealing signals in candlestick trading. In theory, the doji acts as indecision amongst traders as to the direction price will take. The doji candlestick occurs when the open and closing price are equal. An open and close in the middle of the candlestick signals indecision. A long-legged doji occurs after small candlesticks that indicate a surge in volatility and warn of a potential trend change. And the four-price doji is a little bit rare. The four-price doji is where the high and low are equal, or normally and only seen on thinly traded stocks. The gravestone doji. The gravestone doji is created when the open, low and close are the same or about the same price. As you can see illustrated here, the long stem closes low and open at the bottom of the stem. This is a bearish candlestick. The most important part of the gravestone doji is the long upper shadow. The long upper shadow is generally understood that the market is testing to find where supply and potential resistance is located. The dragonfly doji. The dragonfly doji occurs when the open and close are near the top of the candlestick and signals reversal after a downtrend. Control has shifted from sellers to buyers. So let's just recap before we go ahead into this webinar and talk a little bit more about the actual candlestick itself. So when you're looking at a bullish candlestick, you can see here that the long white line is a sign that the buyers are in firm control. And you can see here a very descriptive bullish candle. Where on the right hand side, you can see here that a long black line shows that the sellers are in control, and you can see that it's very descriptive in when you're taking a quick look if your time frame is a daily, weekly, or even shorter. You can see who's in control by the bullish candlestick and the bearish candlestick. Shadow and tail. The shadow is the portion of the trading range outside of the body. We often refer to a candlestick as having a tall shadow or a long tail shadow. A tall shadow indicates resistance. A long tail signals support. The Marabazoo candlestick. The Marabazoo are even stronger bull or bear signals in the candlestick patterns. Note they have no wick at the bottom nor the top. They show us that the buyers or the sellers have remained in control from the open to the close. Therefore, they have no intraday retracements. A very bullish signal or a bearish signal when you see this candle. The hammer and the gravestone. The hammer is not as strong as the dragonfly candlestick, but also signals reversal after a downtrend. Control has shifted from sellers to buyers. So the shadow of the candlestick should be at least twice the height of the body. A greystone is identified by open and close near the bottom of the trading range. The candlestick is the converse of a hammer and signals reversal when it occurs after an uptrend. So let's take a look at clusters of candlesticks. How one candlestick relates to another will often indicate whether a trend is likely to continue or reverse. Or it can signal indecision when the market has no clear direction. Engulfing candlesticks. Engulfing patterns are the simplest reversal signs where the body of the second candlestick engulfs the first. So when you look at the left hand side on this bull sign, we can see that we've got a sell off in the market, and then you can see it's like a key reversal or a reversal day that the bull candle engulfs the previous candle. And then on the bearish side, you can see that the bull day was very small, and then the bearish candle was very, very big. They often follow or complete doji, hammer or gravestone patterns and signal reversal in the short-term trend. The Harami candlestick. The Harami formations, on the other hand, signal indecision. The Harami candlesticks indicates loss of momentum and potential reversal after a strong trend. The Harami means pregnant, which is quite descriptive in its own way. It means that the second candlestick must be contained within the body of the first, though the shadows may protrude slightly. Hangman and hammer patterns. So a hammer candlestick is a bullish signal in a downtrend, but is called a hangman. But when it occurs in an uptrend and is traditionally considered a bearish reversal signal. As you can see, I've outlined the hanging man. After an uptrend, signal reverses. So you've got a nice trend going up, and then you've got this pattern forming afterwards. Candlestick star formations. Star patterns highlight indecision. A long body followed by a much shorter candlestick with a short body indicates the market has lost direction. The body must not overlap, though their shadows may. Reversal is confirmed if a subsequent candle closes in the bottom half of the initial long candlestick body. The morning star pattern. The morning star pattern signals a bullish reversal after a downtrend. The first candlestick has a long black body. The second candlestick gaps down from the first. The body displays a gap, but the shadow may still overlap and is more bullish if hollow. The next candlestick has a white long body, which closes in the top half of the body of the first candle, as you can see here. So we've got a downtrend, got a small candle at the bottom, and then a stronger trend comes through and closes halfway across, which gives you that morning star in this instance. The evening star. The evening star pattern is opposite to the morning star and is a reversal signal at the end of an uptrend. The pattern is more bearish if the second candle is filled rather than hollow. So as you can see here, we've got a bull trend, then we've got the evening star on the top, and then we have the market falling, and then when it falls halfway from that whole candle stem, gives you an indication that the market's breaking down. A doji star pattern. A doji star pattern is weaker than the morning or evening star. The doji represents indecision. So when you're trading and you see markets, whether they're the time frames at 1 hour, daily or weekly, and you just see that you get this doji pattern coming through, always remember it's indecision in the market. The market's not sure whether to continue on from the trend. So if you had a few candlesticks that are going up and then you get a doji, it just represents that the market's indecisive in terms of going any further. So the doji star pattern requires confirmation, of course, from the next candlestick closing in the bottom half of the body of the first candle. So what we should look for is wait for the confirmation by a close underneath this line that I've illustrated here. The shooting star. With a shooting star, the body on the second candlestick must be near the low, at the bottom end of the trading range, and the upper shadow must be taller. This is also a weaker reversal signal than the morning or evening star. The pattern requires confirmation from the next candlestick closing below halfway of the body of the first. So as you can see here, the market has rallied, recalls the highest price of the day. You can see where it opened and closes, and the lowest price of the day. So what we need now is the next candlestick needs to close. If you see the opposite candle on the left hand side, it needs to close underneath that line to confirm that we have identified a shooting star pattern.
Well, that brings an end to our tutorial. Thank you very much for joining me. I hope you find this research useful to your trading.